Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Where's the difference? So why would a trader look at one opportunity versus the other? What would be the relative advantages in a trade that went well to buying that call versus contrasting this with just buying the Forex position? So going in and buying a mini contract from the dealer and posting that margin. Well, here's the big difference. This all comes down to risk. And in the market, I'm going to overgeneralize a little bit, but in the market we generally say there's two kinds of risk. There's market risk, which is that's the risk that's in any specific position that it's going to go against you, that something's going to surprise you, and your forecast is going to turn out to be wrong, and that our long position on the euro, turned out to be incorrect. It just whipsawed, and the market, headed right back down again. And traders will do a couple of things to try to mitigate market risk. The other kind of risk, of course, is systemic risk, which is, you can't avoid it. It's just one of those things that happens. Anybody who's been trading any time in the last 10 years should be pretty familiar with what systemic risk is. So we're going to ignore it for now, because traders spend a lot of time trying to minimize market risk, to try to fix it so that they have a known risk amount instead of an unlimited risk amount. Especially Forex traders spend a lot of time doing this, and will construct very elaborate conditional orders to try to do this. So and which all kind of fall into this category of stops. And they can use stops as through hedges, or they can use stops through just a stop loss, stop limit orders, etc. And let's say that as a trader we're looking at potential upside here of 600 pips, and what if just hypothetically we'd had set a 150 pip stop loss? So meaning that if we got into this trade, and for traders who are looking at the index that the options are based on, this would be like a $1.50 stop loss, so 1.5. So what if we got into this trade and we set 150 pip stop loss, and we got in back here on the 1st of July, and things are going along just fine, no problems, and maybe we're even trailing that stop loss, which is it's a very common strategy, and all of a sudden we run up against the 8th through the 12th of July, and the market moves down over 150 pips. It doesn't look like it moved that much, but it moved down over 1.5 points over that period of time, or 150 pips if you're a Forex trader. And a Forex trader at this point, they're stopped out. Now the question becomes, do they get back in? They'd originally targeted, based on the technical pattern, most traders were targeting about, anywhere from 130 to 131. And they're missing out on this upside, or they're having to redecide, when do I get in? And the lag between the time that they were stopped out and the time they're able to re-enter the trade can put them at a bit of a disadvantage. So now, this doesn't mean that traders who are used to trading in the Forex should always opt for an option. It's just one of those alternatives that may work out really well when we're targeting a nice trade, but we're a little worried about volatility. And this is the perfect example. An inverted head and shoulders pattern is really attractive, but at its heart, it's a counter-trend move. So counter-trend moves tend to be, a little bit more risky. I think most technicians would agree that, trading with the trend is usually a little less risky, but the upside can be really attractive. So traders may take that position anyway. And this would be the kind of scenario where we would evaluate an option, because here's the difference. The call cost us $3 to get into, and we already know that's our max risk. We know that that's the most that we could risk. So while a Forex trader, this is really common, and you may, I would suggest there's a high likelihood that you may fall into this category at times, where you get stopped out more than once. So if you had 150 pip stop loss and you're targeting 600 to the upside, did you get stopped out twice? Because if you did, you've now equaled the amount that was spent on that call. That call has limited risk because you're long. So you only have that $3 at risk, which means that if the market broke out here on the 1st, and then it didn't just go down 150 pips, maybe it went down a lot more. Maybe it went down 300 or 400 pips to the downside. You didn't get stopped out because you didn't have a stop. You just let the call ride because you knew this was the most I have at risk. Now, all of these things that I've just looked at are all variables. So you can buy calls that are a little further out of the money, and therefore they cost a little bit less in absolute dollar terms, but they're probably a little bit higher risk position. You could buy a shorter expiration, and in fact, I'm going to look at an example of that here in just a minute, which would also bring down the cost of that particular position, but you have a little bit less time for the trade to work itself out, so that's something we'd have to keep in mind. So we have a whole bunch of variables that we can kind of tweak to meet our investing objectives. So if in July we felt really confident we didn't want to buy 60 days worth of expiration, we only needed 30 or whatever it is, then we could have spent a lot less on this call and therefore actually reduced our exposure to the market in absolute dollar terms because we weren't planning to, either the trade was going to work out in the short term or it wasn't going to work out. And so we can place this trade with a shorter expiration and save a little bit of money. So we have a lot of variables that we can use to play with here. So I've done a little contrasting here. The advantage of a call option in this case, completely ignoring buying the spot contract itself, is I think fairly self-evident. The disadvantage, of course, with options is you've got an expiration, you can't hold it indefinitely. And it's going to cost you pay money up front to buy that long position. And we are going to be talking about long positions pretty much exclusively today in my presentation. So those are two disadvantages that kind of offset are the contrast to the advantages. This is what I mean when I say that traders are looking at these kinds of opportunities to try to make sure that they're taking the trade that really fits with their trading objectives, with what they're trying to achieve. Okay, so let's shift gears here a little bit. I wanted to do that just to provide, a little bit of background as to, why do we even evaluate this? And that's why. It gives us a little bit more flexibility. It gives us more alternatives than just an outright position with a stop loss in the Forex market.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.